Great. Welcome, everybody. This is Zach Miller from OurCrowd. We literally have hundreds of people, both entrepreneurs and investors, who have dialed in from around the world to join us tonight. While we've done webinars periodically, most of the time they're about our deal launches. Most of the time they're about the companies that we're currently investing in. We're now rolling out a series of which this is the first, called Teach-In Tuesdays. These will be geared both for entrepreneurs and for investors with different topics around the investment process. Tonight we're going to be talking about the life cycle of an OurCrowd investment, following a company's progress from due diligence to investment and beyond. And really, when we created this presentation, we had both entrepreneurs, people who may be interested in working with OurCrowd, to help launch them with their first venture round, as well as our investors, both current and future investors, who want to see sort of how OurCrowd works, how the process works, and in some sense, this can be generalized to an investment process, early stage angel investing, whether you work with OurCrowd or not. We'll talk a little bit more about OurCrowd and how we do it, but first I'd like just to introduce myself and my co-host. My name is Zach Miller. I run the investor community here. I'm a partner at OurCrowd, and it's my job to help new investors. We have a lot of people who are coming to OurCrowd who are experienced in the angel investment process, a lot of investors who actually, this is their first foray into private equity. They're coming to us, and I hope we do a pretty good job of educating our investor community, both with information about the investment process as well as information about the specific companies that we're funding. To date, we funded over 30 companies, invested over $30 million in our portfolio companies over the past year, and we're just getting started. Primarily, we're focused on Israeli investments. That's evolving as well as we sort of reach out to a global community of entrepreneurs. So before I really turn it over to David Stark, who's my co-host, just a little bit about the housekeeping tonight. You will be able to ask questions at the end. You'll do it through the Ask a Question button on your webinar panel, on the meeting burner panel. Those questions will come to me. I will ask them out loud at the end of the presentation. So if you have any questions, whether in the beginning or the end, submit those to me and I'll be able to answer them. What you should expect is about an hour long. We try to make sure that we're in and out within an hour, so you'll be able to get off and go do what you need to do. If you have questions, follow-up questions, feel free to reach out to me, to reach out to David. There's a lot of information on our website as well at OurCrowd.com. And again, I'd just like to thank everybody, the hundreds of investors we have from around the world, and entrepreneurs, I should say, who are joining us tonight. So without further ado, let me introduce my partner, David Stark. David?
Thanks, Zach. Hi, everyone. As Zach said, my name is David Stark, and I'm on the investment team here at OurCrowd. Today, I'm going to walk you through the process that we use to screen and diligence early-stage companies. As Zach said, the goal of this portion of the webinar is first and foremost to give transparency into our process so that as an entrepreneur, you could better understand what we're looking for, and as an investor, you can understand the value in working with our team of investment professionals. So the primary objective of our investment team is to identify and negotiate the best early-stage investment opportunities in the market. And in order to do this, it's critical that we build a deal flow pipeline of the highest caliber. Our deal flow really breaks down into two categories. So you have incoming deal flow, and you also have outbound deal flow. So the incoming deal flow works in a number of different ways. So first of all, we have our website, and any entrepreneur is invited to come to OurCrowd.com, and you can submit an application for funding. We end up with tens, if not hundreds, of applications coming through the website every month. To give you a little bit of perspective, each month we're seeing 150 plus deals at the top of our deal flow funnel. Actually, in January, which was a very high month, we saw over 300 deals that we did an initial screen on. And that's kind of the first way that we receive deals is through the website. The second form of incoming deal flow that we receive is through our network of contacts. People within our network really kind of vary between our portfolio company CEOs. To me, as a member of the investment team, one of the most exciting things that I've experienced is that a CEO that we've invested in already is so excited, enthusiastic about working with us and what the process has been like and the value add that we've brought to their company, that when a friend of theirs says, hey, I've got a startup and now I'm out in the market looking for fundraising, the CEO will say, well, the first place you have to go is OurCrowd. And I think that that's a great testament to what we've been able to achieve in terms of building a quality portfolio and proving our value to our companies. The second source of kind of inbound referrals that we have is other OC investors. This is something, again, that I think is a great testament to the community that we've built. And we have a diverse range of investors that span multiple geographies. I think the last I checked, we had active investors from 19 different countries. Those investors cover a wide range of domain expertise. So we'll have some investors that have access to quality deal flow in the medical field, other investors that have quality deal flow in the software field, and investors should always feel welcome to forward us on any interesting opportunities. And then the last kind of source of referrals that we have are just other people within the VC ecosystem here in Israel as well as abroad. Probably about 70% of the investments that we've done to date are alongside other venture capital funds or prominent angels. And again, I think it's a great testament to their experience in working with us that over and over again, they're now trying to share deal flow with us and find other opportunities for us to work together and invest alongside each other. And as I'll get to later on, we kind of really believe that investing is a team sport, so we're always excited to have great co-investors that are sharing deal flow with us. So that kind of covers the inbound deal flow side. And then the last point I want to make about how we source opportunities is that we actually will also proactively reach out to great companies. So if we'll read an article about a company that's very exciting, or if we'll be at a convention or at an event where a particular company catches our eye, then we will actively pursue that opportunity, and we'll reach out to the CEO, and we'll do whatever we can in order to get an opportunity to invest in those companies as well. So that pretty much covers how the funnel's created, and as I mentioned, we're seeing 150 deals a month. So how do we possibly go through that many deals? Well, the first thing that we do is we use OurCrowd's 6 investment criteria as an important initial screening process. The criteria, the first thing that we focus on is a great team. What we look for in a team is a number of different factors. Ultimately, the most important one of which is that they're just really good people. We only want to be investing in people that we view as being, good long-term potential partners, people that share our same vision for the company and that really have a passion for what it is that they're building. On top of that, there are other things that give the teams a particular bonus in our eyes, one of which is serial entrepreneurship. There's a lot of research that suggests that serial entrepreneurs who've founded and successfully or unsuccessfully exited companies in the past are actually more likely to succeed in subsequent ventures. So for that reason, we're really excited when we have an opportunity to invest in serial entrepreneurs. The next piece of the criteria is a large market. We're really not looking for opportunities where they're targeting niche markets. We're interested in investing in companies that have the opportunity of being billion-dollar companies. So we really need to make sure, and we always drill down on what the addressable market size is. The next criteria is easy to understand. This is for a number of reasons. One is that the nature of OurCrowd's model is that our investors, again, they span the globe and they have varying degrees of expertise within different fields, and we think that it's very important to be able to clearly and concisely communicate a company's value proposition to all of the investors using the various tools that we make available online. And if we were looking at a company where it was super esoteric or complex, that really wouldn't work for the members of our community. But even more than that is not just the issue of the fact that being an online community, it's important that things are simple to understand. We also just fundamentally believe that a CEO should be able to, dumb down per se what it is that their company is doing and what's the pain point that they're solving and what they believe, the successful road to market and path to exit is. And if a company can't properly express that, then we're not very interested. The next piece is traction. We're not interested at this stage in investing in companies that are pre-products, that are just a couple of people with a PowerPoint. That's not what we're looking for. We're looking for companies that are either already in the market and have real customer traction to show for it, or they're on the brink of commercialization, but yet they've already done significant amounts of R&D and built a substantial IP portfolio. So traction can really be defined in a number of ways. It depends on the particular sector. But what we are looking for are companies that already are leaders in their field, which means that there already needs to be some sort of traction that's been exhibited, which also then helps us in our diligence process of investigating that traction. The one caveat I'll make is that for serial entrepreneurs, sometimes we're willing to take a bet on them at an earlier stage. And if you look at the really seed stage investments that we've done, it's usually because those are people who've built and sold companies before. The next piece is sponsorship. As I mentioned before, we believe that investing is a team sport. So if we're investing alongside other great institutional investors that bring diverse set of opinions and diverse ways of adding value to the company, we think that really creates a good recipe for success. And then lastly is a good deal. We are valuation sensitive at the end of the day, and we want to maximize the returns for our investors, so we always pay attention to the economics of the deal. Moving on is the due diligence process. So once we've kind of used those 6 criteria to screen through the 100+ applications that we receive a month, we probably end up meeting with about 25 management teams each month. Of those, a smaller subset, let's say 10 a month, we think are really interesting, and we'll set up follow-up meetings with management. And then maybe about 6 a month, we'll start digging in and doing deeper due diligence. So the level of due diligence that we like to do hits on a wide range of areas, and these are all ways of us making sure that this investment is a worthwhile investment. So the first thing is we do customer calls. So if a company is already out in the market, there's no better feedback and no better way of evaluating a company's product than speaking directly to customers. So that's something that we always do. Financial review, we'll review a company's budget and their projections. One thing that I would note about this point is that it's very important to us to not underfund a company. So if a company says that they're only looking to raise $750,000, and then we go ahead and look at their budget and we see that we actually believe that they're going to burn through that money before reaching their next significant milestones that would then create an uptick in the company's value, then that's something that's a red flag for us. So we always want to make sure that the amount of money that they're raising in a given round matches up well with what their financial budget is. Next is third-party expert opinion. One of the things that we spend a lot of focus on is creating a network of mentors. These are all people who are third-party members of our network who are real industry experts who've either built and sold companies in a particular space, or they have years of experience working within that field. And when we're doing deep due diligence on a company that we're interested in investing in, we'll always get the feedback and involvement of one of these mentors and have them meet with the company and do their own review. Next is a human resource check. We actually have one of Israel's leading HR consultants who we have her go and meet face-to-face with the management team and write up a thorough evaluation to make sure that that team is prepared to be able to take the company the distance. Then we'll do kind of other analyses like a competitive analysis and market sizing, in addition to a whole bunch of other things that we make sure to get comfortable with before moving forward with an investment. So once we've then completed the diligence and made the decision to move forward, the next step is actually negotiating and agreeing to a term sheet. So for those of you who don't know, one of the interesting things about a term sheet in general is it's not actually legally binding per se. In the venture industry, term sheets are used as effectively as a letter of intent, saying, based on these and these terms, we expect to close an investment of this amount by this date, and we and the company sign on that agreement. The terms of the deals that we do really vary on a deal-by-deal basis. That's because we're investing in things that are at different stages as well as different sectors. So I wouldn't say that the terms are always boilerplate across the board, but it is always important for us to make sure that we secure the most important rights and protections for our investors. So there are certain things like getting preferred shares and preemptive rights and anti-dilution rights that we always try to make sure are in every deal that we do. And from a process perspective, I would just note that there are some times where OurCrowd is the lead investor in a round, and that means that we're actually originating the term sheet for that round, and therefore we're the ones who are actively engaged in the negotiation process and coming up with a valuation that we agree upon. And there are other times where there will be another institutional investor who's leading the round, and our term sheet process, instead of a negotiation, is really a review of the terms that have already been agreed upon by the company and the other institutional investor, and deciding whether or not we are comfortable with those terms as well. So the next thing that I'd like to do is hand over the call to Zach, and Zach will now walk us through, once we've signed the term sheet and we're ready to go live with the investment, what the process looks like from there. Zach?
Thanks for a great presentation, David. Before I let you go, there was a question that came through. I might as well ask it now since we're on the subject of term sheets. You mentioned that OurCrowd sees 100 to 300 in January, potential deals per month. About how many term sheets do you think you work on per month?
Yeah, it's a great question. We're probably working on 2 to 3 term sheets a month. So just, again, so if you look at the numbers, we have lower than a 2% acceptance rate from the amount of companies that are coming in through the top of the funnel.
Great, thank you. So David just took you through the entire due diligence process we have, from a deal coming in over the transom or through one of our referral partners or through another investor that we know, all the way up to our due diligence and us getting comfortable with the deal. If we were a typical venture capitalist at this point, we would end up making an investment, but we're not a typical venture capitalist. We do approach the due diligence similar to a venture capitalist, but then we have this crowdfunding component to our platform. So that's where a deal launch comes into effect. And that's sort of where my role sort of begins to kick in. So that's after we've gone through term sheets, we've negotiated the terms of a deal. At this point, we actually open up the deal to our investor community. So what does that mean in OurCrowd terms? That means we do a webinar just like this one, but we'll have the entrepreneurs, the founders of the company, on a call with our investor community. So, David mentioned we had investors from 19 different countries around the world. That number's actually been updated to 23 over the past month. We have investors on all different continents. This is the one opportunity to get everybody on the call to ask specific questions of the entrepreneurs and to hear the entrepreneurs pitch the companies in their own terms. And as David said, an entrepreneur, a CEO, needs to be very crisp in terms of his delivery of the idea that can help sell the idea. That comes into play here in the webinar. We also produce, and David's part of our due diligence team that creates something called the OurTake. I think this is a differentiator on our platform. The OurTake is similar to the way an investment bank would provide analysis on a company under coverage. We include a lot of our due diligence materials in that OurTake. This is why we're making an investment. One thing we didn't say along the way, because we approach this like investors, we actually put money into each deal. We put around $50,000 into each deal before everyone else joins us. That shows that we've gotten comfortable with this deal, and we have skin in the game we sit on the same side as our investors. We take a presentation. We work closely with the companies to hone their presentations. A lot of times, young entrepreneurs, have a very strong bent towards product marketing. We make sure those presentations are very attuned to investors to answer questions that investors ask. We produce a video. Again, because we're doing this virtually, because we can't get our CEOs in front of all of our investors, our thousands of investors all over the world, we produce a video which is about 90 to 120-second video of the investor pitching his company in his own voice. We think that's important to get closer to the opportunity. We write up some material about the team, and for us, for many of our companies, we do take them on the road. Primarily, that's been in the U.S. We've hit Europe. We have a lot of investors in Australia. We're beginning to expand our South American presence as well. We'll get our investors in a room with our CEOs so that they can ask questions, and a lot of times, those are the times that, in my mind, the Q&A sessions of those events, not just hearing the entrepreneurs speak, but hearing their answers to specific questions, very, very crucial part of the investment process. So that's what we talk about at deal launch. That's when a deal that we've been working on for months, that David and his team have been working on for months behind closed doors, becomes public, and that's when we start actually fundraising for the company. So if you come to our website, you'll see that all those materials I just spoke about, a recording of the webinar, our take, our analysis on the deal, that appears on the website. And investors have the ability to actually invest off the website. So there's a button that says, I'm interested, a big orange button that says, I'm interested. And for first-time investors, maybe a little bit scary what happens after that process. But basically, it's a lot of back office work. At that point, you'll be sent a variety of documentation that has to do with subscription agreement, with wiring instructions, closing paperwork. There is, for new investors to our platform, just like in every private equity deal, it's not like buying a stock. It's not a liquid transaction, and you have T+3 where the deal closes, where a transaction closes in 3 days. It could take weeks, and for a little more complicated deals, it could take over a month. So there's a patient period there. We try to do our best to communicate, sort of why it's taking so long. But, at this point, we're actually going out and saying, okay, everybody who's committed to the deal, we'd like you to fund your investment, and that just takes time to get that in. We have launched a product called Portfolio Reserve. We're going to be doing another webinar on that. You should have seen that in the launch email that you got. That's a new product that we built. That enables people actually to make a one-time investment at OurCrowd and deploy capital automatically out of that. So it's almost like a mutual fund. You can think of it that way. I'm gonna fund my account with $100,000. I believe in the portfolio process. That's something we preach to everybody, building a diversified portfolio of angel deals. Portfolio Reserve enables you to do that automatically and without having to fill out the paperwork each time. So I just wanted to make that caveat. So if you do sign up for Portfolio Reserve, the process of how it's a lot easier in terms of what you have to do. Let's move on. So the next stage of what we think about is, okay, we've launched the deal. After going through our full due diligence, we've rounded up all the money. Our money is in. Our investor money is in. We make a wiring, and we're now investors, officially investors. So at that point, OurCrowd kicks in our monitoring and support function, just like a venture capitalist would do with their portfolio companies. We want to help ensure the health and success of our companies, and that's where monitoring and support comes in. So as a crowdfunding platform, we take the responsibility of reporting for our companies. Our companies don't necessarily want 150 investors calling them, asking them questions about every part of their business. So we sit closely with the companies. We make sure that we take what we're hearing from them in our discussions and communicate that to investors. So somebody who makes an investment on our crowd platform will have a My Investment section of their portfolio. If you click on that, you'll be able to get just like you would if you use Charles Schwab or use Fidelity for stock market investing. There's a My Investment section there, so you can get a view of what your holdings are. We do report quarterly and yearly, so you will be hearing from us on a quarterly basis with an update of what's going on. We do our best to provide ongoing news flow. So a lot of these companies are early stage. They're not necessarily hitting the pages of the New York Times every day, but instead they're having sort of incremental successes and landing new partnerships, new trading partners, new customers, whatever it may be. We do our best to communicate that to our crowd. We also do events and roadshows once a company has been funded, just to get them in front of people and keep the momentum going. here's something we talked about, we haven't talked about enough, and this is something that we're seeing emerging, which I think is really the game changer, not just with OurCrowd, but with crowdfunding in general. It's something we called crowd building, and we had a editorial in the Wall Street Journal addressing sort of this topic. But crowd building is really it's the dream of what crowdfunding aims to be. We're not just deploying capital in small increments with all of our investor base. The fact is we're getting, whether it's 40 or 60 or 70 investors investing in a company, you guys are really smart, and you guys come from, you have your own backgrounds and professional relationships. You can actually help build the success of these companies. So it's not just putting money into companies, it's putting smart money into the companies. So our investors have made investments, and afterwards they come to us and say, how can I help this company grow? That's where crowd building comes in. We've had intros made, real life things that we can speak to. We had one of our companies here in Israel sit in front of the Brazilian Chamber of Commerce. Somebody in the crowd had seen them pitch, and the guy was basically like, will I sign up? And he ended up, making a purchase order of 15,000 units for this technology company. It happens. It also helps with hiring decisions. We had a post in Forbes about the power of crowd building, and our investors are introducing us and our portfolio companies to some of the top talent in the world. Our investors are the ones who are bubbling that up. And of course, we provide educational events like this one today. This is going to be an ongoing part of Teach-In Tuesdays, where 2 Tuesdays a month we're aiming for, where we're hopefully bringing in valuable content with valuable speakers as well to help people understand, both investors and entrepreneurs, sort of how this process works. So that's the monitoring and support side. It gets even a little more nuanced. So it's not just monitoring and support, it's actually trying to optimize or maximize the value of our investment and our investors' investment. So one of the things we do, as David mentioned, is we try to provide mentorship. Most of the time that comes in a board seat if we're able to negotiate that on behalf of our investors. We don't necessarily take those board seats, but instead we appoint one of our mentors. We have a community of 20 or 30 mentors, some of the top technologists and business people here in Israel and abroad, who will represent our investors' interests on the boards. And not only will they represent and report back, but they're helping to build these companies as well. We just started doing CEO meetups and education events for our CEO community to help them help themselves. We bring in, also just like these educational events, we bring in qualified and helpful professionals to help the CEOs build their businesses. A lot of times, just getting them to sit in a room together and cross-pollinate ideas between the companies is very, very useful. Given our founder, John Medved's celebrity status in the media, we can help a lot in terms of bringing visibility to our companies. We make media introductions and provide sort of PR guidance for our companies to make sure, if it's time for them to start getting the word out about their products, we can help make those intros. We've done that time and time again. Strategic partnering, right? So all of our crowd has, our partners here have a tremendous and long and deep history in helping to build businesses. We bring that to our companies as well, and obviously that benefits investors in our companies. So we can help make introductions not only to potential business partners, but also to potential investors down the road. That's one thing we do as well. This is not unsimilar to what a regular VC does, and provide advice. We provide, obviously what we believe to be sagacious advice, where we're helping our companies sort of navigate the waters of growing a young early stage company. Something I think that's important both from an entrepreneurial point of view, but also from an investor point of view. If you think about what institutional investors do when they make an early stage investment, they leave money aside for follow-ons, right? So basically, they're making an initial investment with the assumption that probably, not always, but probably at some point, that company will need to raise money again. And we tell the same of our investors, right? So we're doing mostly Series A rounds. So these are young companies with just beginning of their revenues, with a product in the market, starting to grow. They probably will need to tap the capital markets again. So our investors, given some of the term sheet stuff that David was talking about before with the protections and rights that we negotiate on behalf of our investors, you'll probably have an opportunity to re-up your investment in a company. That's what institutional investors do, and that helps sustain these companies going forward. There are very few companies that can go from startup to exit without raising money again. We do believe there's an importance on this participation. It does prevent dilution on the investments that matter. Again, we do preach the portfolio approach. If you look at the Kaufman Institute's statistics, typically 10 to 12 investment portfolios do the best for angel investors. Some will end up zero, some will end up really big. It's hard to pick them, and that's why we're building a portfolio, and we tell our investors to do the same. There's certain signals here, and David Stark made me emphasize this as well. When you look at sort of a subsequent round of funding, there's certain signals that are coming out. Is there a valuation step? Was the first round done at a lower valuation? Are we seeing a significant valuation step up, to show that the company has increased in value? Is there new money coming in? Has the company been successful in convincing other investors of the investability of their opportunity? And typically, we like to see institutional investors as well. So we may lead an early stage round. We're going to work and monitor and support that company until it gets to a stage where actually a larger institutional investor with deeper pockets is going to come in and make an investment. That's obviously a very healthy signal for investors. So that's what we do. Once we launch a deal onto our site, we fund a company and continue to fund it and continue to support it along the way. Obviously, what every investor wants to know is how much money and when do I see my money back. I do want to turn that piece over, how investors make money on their investments, to David Stark. So David?
Thanks, Zach. We actually just had a few questions come through in the chat box related to this point as well. When you think about getting your return of capital as well as your profits, this really can happen in one of three ways. The first one is for the company to grow into a large and profitable company, and even without an exit, the company can issue dividends to the investors. So that's the first way. The second way would be through an exit, which would be either an M&A, which is a merger or acquisition, or an IPO, which is when the company goes public. Both of those would also trigger a distribution to the investors. And then the last method, although this is not the ideal outcome of the three, would be if the company decides to close up operations and to liquidate its assets. So then whatever amount of money would be recovered via that liquidation would also then trigger a distribution as well. So those are really the three ways for the investors to get their money out of the investment. Some of the questions that have come through are related to the expected investment horizon as well as expected returns. What I would say is typically on average, you should expect that exits won't happen until the 3 to 5 year time horizon. That being said, some investments could drag out as long as 7 to 10 years prior to a successful exit. And on the opposite end of the spectrum, you might get extremely lucky and have something exit within the first year. This is obviously fundamentally related to the stage of the company at the time of investment. So if you look at OurCrowd's kind of investment history over the past year, we invested in some companies where it was pre-product, and other companies where they've already have a few $1 million of revenue. So given the relative stages of those companies, you'd believe that the later stage company is closer to exit. I'll only mention though, that's not always the case, because sometimes those really early stage companies, their intention isn't necessarily even to get to the point where they're fully commercialized and ramping revenues, but yet they're developing a really core technology that is attractive for a larger strategic partner who would want to just buy it at a really early stage and tuck it into their own product. So there's not always a correlation between the stage of the company when you're investing and the expected time horizon to exit. In terms of the investment returns that you should expect, like I said, we're investing in companies that we believe are going after really large markets and have the opportunity to be billion-dollar companies. So when we really think about investments, we like to believe that every investment that we do has the potential of generating a 10x return. That being said, as Zach mentioned, because early stage investing is extremely risky, a portfolio approach is really important because a large number of those investments will end up going to zero. But again, the ones that work out will hopefully generate substantial positive returns, and then the average returns that you could expect would be somewhere in the 2.5 times, 3 times your money over the 3 to 5 year horizon.
Thanks, David. So a lot of questions did come through. I just have a couple more slides. I'm going to go quickly through those slides so we can actually get to the questions, and I'll bring David back in to help answer some of the financial structural questions as well. So as I mentioned in the beginning, OurCrowd, we believe, is a better way to invest in Israeli startups. We have boots on the ground here in Israel. Our dealflow team is based here. We feel we have an advantage having spent 25 years of investment history here in Israel. We will be expanding on a limited basis to start doing more international deals. We've done a couple opportunistically, but primarily we are a better way to invest in Israeli startups. So just talking about where we've come from and where we're going. It's been about a year, and we've invested in over 30 startups. Again, David said there's about 2% acceptance rate of all the deals that we see. We try to be selective. We are approaching this as investors. We're putting our own money into these deals as well. OurCrowd and our community of investors have invested over $30 million in these firms. And the truth be told, I mentioned follow-on fundings before. We've done also 10 or 11 fundings as well, follow-on fundings. So when we invest in the company, the idea is that we're there to nurture and support it throughout its growth. So I just wanted to give, even just to wrap your mind around it, just a couple sort of case studies on companies that we're funding right now. So if you were an accredited investor and you go to our website and sign up, these are companies you'll see there as well. So just case study one, called Site Diagnostics. This is a very early stage company with a computer vision platform to test blood faster, cheaper, and more accurately. Compared to microscopy, which is just the use of slides under a microscope in terms of identifying malaria so that we can treat malaria. They just did a study in India where they came out to, if you look at a microscope that takes 40, 50 minutes, within 2 minutes using sort of computer vision and algorithms, this Site Diagnostics, which is run by PhDs, it has the ability, with a 99.4% accuracy rate to identify malaria so it can be treated. We think it's a platform. It's not just treating malaria. It can do blood count. It can do everything. So this is something that we thought is a fantastic thing. They have 2 PhDs on staff, one from Harvard Medical School. Young guys based here in Jerusalem, we think with a lot of runway ahead of them. That's just one company that came through. Another one is called Bizzabo. This is software that makes event organizers more money by increasing engagement of attendees. So we've all been to crappy networking events or to conferences. The reason I go to conferences is to network. It's not necessarily to listen to the presenters. It's sometimes hard at in a large audience to be able to connect to people. So this is sort of an all-in-one software. It resides on the desktop as well as on the mobile that allows both event organizers and the attendees to sort of really do social networking the way it should be done in person and to connect to people so they get a lot more out of events. So these are just 2 examples. If you were to sign up at OurCrowd.com, you would see those right now. And both are early stage. Bizzabo is already producing revenues. Site Diagnostic has already done some field tests in India, already is beginning to have orders as well to ship their product internationally. So just a couple case studies to mull over. And that brings us to sort of the end of the presentation. And this is the time where we open it up to you guys. I see a lot of questions in the in the chat as well as in the Q&A. So let's start. So by the way, if you don't know, you can submit a question either in the chat box on the Meeting Burner panel or through the Ask a Question button. And now we can start to ask questions. So here's an interesting one. I'm going to address this to David. Here's a toughie, David. What are the downsides to a company of dealing with OurCrowd? Is it more or less painful because of the unique entity we create? And maybe you should introduce that with the entity.
Sure. So from the company's perspective, and this is a really important thing to highlight, you actually only end up with one investor, and that investor is OurCrowd. So what happens behind the scenes in terms of how many investors are invested in the given deal, it's not like you end up with 50 individual line items in your capitalization table and that you need to send individual reports and get voting approvals from all of those individual investors. So that's the first thing. And in order to do that, what we do is we set up a special purpose vehicle for each investment that we do. So as an OurCrowd investor, you actually own your pro rata portion of that vehicle, then that vehicle actually owns the shares in the company. But I don't think that at all this makes it a more painful process for an entrepreneur. I think it's just like receiving an investment from any other venture capital fund or angel investor. The only thing that I would say as far as the one thing that would be a little bit unique to OurCrowd that some entrepreneurs have to get comfortable with is the idea of sharing information about the company online. Of course, it is a closed community and that information is only accessible to our investor base. But that being said, if there's particular information that a company is extra sensitive about, then they might be a little bit concerned about putting that on the internet. That's kind of the only hesitation that we've ever heard. Other than that, I think that our process is, from my experience, far more efficient and enjoyable from the entrepreneur's perspective.
That's a great answer. A question came through the question and answer box. Do you make a time limitation for the signed term sheet until capital is raised, and what is that estimated period?
Yeah, absolutely. In every term sheet, we ask for about 45 to 60 days. Just anecdotally, I'll tell you that we've done investments that have taken far less time than that. Probably about 3 weeks ago, we launched an investment in a company called Neverwhere, where we were raising $750,000 for the company, and that was it was already oversubscribed within a week. So in those situations, we're able to close the investment much sooner than that 45 to 60-day time frame. But it's just important for us to kind of build in that buffer because that's usually the average amount of time that it takes.
So we had a question that came through the chat box. I'll take this one. Is the funding process reviewed legally from the perspective of public offering? So this is interesting. So what's happening, if you've read, there's been a lot of change, at least in U.S. law, regarding crowdfunding. With the Jobs Act of 2012, the grandiose vision is basically to open up early stage investing to everybody. As of now, we're not doing that. We're still very much focused on accredited investors, and we are publicly soliciting, meaning we are going out there and talking about our deals publicly, but still you have to be an accredited investor to invest with us. So although we're still waiting on the sidelines to see how all the legal structure stuff plays out, and it may be very well that we end up sort of opening up the platform larger, but at this point it's still limited, and obviously that means only people who meet a certain either income or asset test who meet a certain threshold are able to both accredit and invest on our website. And that's very important for our companies as well, by the way. So although there's talk of really opening up crowdfunding and making it completely public and transparent, a lot of early stage companies, particularly good ones, are sensitive about their information, and they don't necessarily want it. They don't want us promoting it. So we're very sensitive to that, and that's obviously a very sensitive part of our business and something that we take very seriously. Let's ask another question. So David, you could take this one. Other than the return on your investment, does OurCrowd take a management fee?
Yes, our fee structure is very similar to that of a normal venture capital fund. So we actually get a management fee that we take up front, and that is 2% a year. We actually cap the management fee at 4 years. So over the life of the investment, even if we're managing the investment for 8 to 10 years or whatever it may be, you only have to pay the management fee for the first 4 years. So that's a 2% management fee up front, and then we take a percentage of the profits on the back end. That's how the fee structure works, and that's pretty much industry standard across all venture capital. Okay,
I'm just trying to consolidate through the questions here. We have a question about our geographic focus. Are all the companies that you've invested in headquartered in Israel? only. Is that correct? So as I mentioned, our crowd definitely is focused on Israel. We feel that not only do we have an advantage here because of our experience and our people here, we think that the Israeli tech scene is really investable. If you've read some of the analysis that came out the last couple years by a variety of different consulting groups, Israel has been identified as the second leading startup ecosystem in the world. We believe it's just getting started. There's tremendous activity going on here. Everybody's got a startup. Everybody's got some real interesting intellectual property, and there's a culture that sustains that. So we think that's great. Opportunistically, we are going to look at deals, particularly if our investors bring them to us from around the world. So just an example, we recently funded a company called Neverwhere, which is based in the U.S. David actually went to school with the founder, so there was a pre-existing relationship there. Technology is great. It's a virtualization technology for schools. So basically, schools don't need, with Neverware's server in the classroom, they don't actually have to go out and replace their the terminals, the computers. Basically, any computer can get hooked up to the server, and the server basically turns every computer into workable, fast, state-of-the-art type computer. So that was based in the U.S., not necessarily a connection here to Israel. We have funded Israeli entrepreneurs who reside abroad, but again, it's an opportunistic sort of one-by-one case. So David, I'm going to address this one to you. After negotiating a term sheet with a venture team, is this actually a guarantee from our crowd that we will guarantee a certain amount of funding from our investors?
Yeah, it's a really good question. The answer is no. Just due to the nature of our model, we can never make a guarantee that we'll be able to hit the target investment amount. So in every term sheet, the language that we use is on a best efforts basis, our crowd will invest, this target amount. So there's no guarantee, but I want to make kind of two comments about that. One is that when you sign a term sheet with a regular venture fund, there's also no guarantee. And I've read various statistics. Some say that as many as 40% of term sheets that are signed with VC funds don't end up closing. So that's kind of the first point, is that it doesn't really matter with us or with whoever that you may be dealing with. The term sheet doesn't necessarily mean that investment will close. With us, we actually take the term sheet very seriously, and by the time that we sign the term sheet, we have already completed our diligence and made the decision that we do want to move forward, right? So that level of the risk has already been removed from the entrepreneur's perspective. But the greatest kind of proof of this is our track record. And probably of the 38 investment rounds that we've done on OurCrowd over the past year, there's only really one example where we didn't hit the target or get extremely close to hitting the target. So that's a very important data point when I sit down with companies and I try to convince them of exactly this point, of the fact that they can very comfortably move forward with us, knowing that there is a high level of certainty of close, and that when we say we're going to make the investment, we're going to make the investment. Because way more often than not, we've actually been oversubscribed in our investments than we've not hit the target investment amount. I will say that sometimes we might get 80% of the way there, but we and the company together will decide that that's still a sufficient amount that it makes sense to proceed and move forward with closing. But to directly answer your question, there is no guarantee.
Hey, David, I'm glad you addressed that last point, because we do have a couple of questions about, what if we don't hit, what if we undersubscribe? We won't call it underfund, because we never want to underfund a company, but what if we don't hit our target? And as you said, David, we'll handle that on a one-off basis. We will go to the company and determine whether that's a sufficient amount of funding. We'll also then go back to our investors and say, hey, we didn't really hit the target. Are you still interested in making the investment there? So we have to make a judgment call at that point, and then we turn it back to investors so that they can make a decision as well. There's been a question about liquidity. Yeah, go ahead.
Sorry, Zach, just to add to that point, I think it also, really depends on the composition of that investment round and the capital needs of the company, right? So if there are other investors around the table and they all are coming in with the full investment amount that they anticipated, and therefore our shortfall doesn't really drastically impact the company's budget moving forward, then that's one thing. But if on the other hand we are the lead investor and we really believe that the company needs to raise this amount of money in order to reach their next milestones, then we always have to take that into consideration.
That's a great point, David. Actually, a great point. A couple people asked a question about trading or liquidity in shares. I can take that one. So these are early stage investments. They're private investments. If you could theoretically find a buyer of your shares, you could sell them. But these are investments that we tell our investor community that you have to get comfortable marrying. You're going to be stuck with them for a few years. It has to be a long-term investment. You don't want to use the funds that you have set aside for your kids' college tuition. These are things that are relatively illiquid. I can say one of the promises of crowdfunding, and as we grow, something we'd love to be able to offer at a later time would be, the ability for our investors to sell their shares to one another. That's way down the road. That's not something we're actually planning right now. But in general, these are illiquid investments. David, I'm going to throw this one at you, particularly because it's a hard one to answer and something that we talk a lot about internally. So we talked about underfunding or not hitting a target. What about if we have an oversubscription, right? So we're doing $1 million round, and OurCrowd actually is successful with what we do. A lot of investor interest, and we get to we actually have $2 million worth of interest. How do we handle the allocation of the investment?
Great question, Zach. So we handle this in a number of ways. So first, what you'll see if you're a veteran member of the OurCrowd community, that you've already seen this. If you're a new member of the community, then you'll be sure to see this. But the moment that we hit a certain level of commitments in an investment, we actually will put up a waiting list flag on the tombstone of that investment on the site. So just by the very nature of the investment business, there will always be some people who end up not being able to follow through on their commitments for one reason or another, which usually then opens up opportunities for investors on the waiting list to get in. So that's the first point. I would encourage everyone that even if a deal looks like it's already been fully funded, but it's in the waiting list period, don't be discouraged. And if you really like the investment, I encourage you to still make the commitment because then on a first-come, first-served basis, we would be able to get you in if there's any availability. But even prior to getting to the waiting list, we do really believe in this democratization of the investing process, and we want to give everyone an opportunity to get educated about the investments and to do their homework and to attend the webinar and to really have sufficient time in order to make that commitment. So what we'll usually do is that if a deal is extremely oversubscribed within only a few days of launching the investment, then we'll try to scale investors back pro rata in order to be able to accommodate the increased investor interest. But after kind of a few days or a week-long period, if then it hits the fully committed amount, then we'll move over to the waiting list. We're actually right now working on a process document to explain to people how everything works in the event of oversubscription, and we're going to be sending that out to all of the investors, so you can expect to see that within the coming weeks.
That's a really good point. And so, when we sat in a garage ourselves and figured out how can we disrupt, sort of traditional ways of funding early stage companies, democratization was really important. It was about making sure that everybody could get a piece of a good deal. On the other hand, obviously, there's limited room in certain deals, and so there's some type of gamification there as well. And we want to reward people who make an early commitment. So again, we're about education. That's why we produce all these materials, put them up on our website. We want people to spend the time and really get drill down into the materials that we provide, and to make a learned decision about when they make an investment, and not to do it sort of just because the crowd is doing it. So it's sort of a push and pull that we're continuously fielding, and it's obviously a good problem to have both for our investors and for our companies, but it's something we're very focused on. we had a question come through in the Q&A panel about the average number of investors per successful first investment round. So I can answer that. I could say the answer is going to be, it sort of depends. Obviously, we've done rounds as small as $300,000+. We've also done $2.5 million. So the rounds, as they get bigger, there are going to be more investors in it. So I'm not sure the average necessarily would be the right way to approach that. So I can say in one of our larger rounds, we had 60, 70 investors, and some of our smaller rounds we've had probably less than 10. So it sort of depends on the round size. Sometimes institutional investors do invest alongside us. So if you've been paying attention to what's going on with OurCrowd, we did release a press release in November that GE is signed a partnership with us. So they're looking at all these deals as well. So it's that fine line between providing democratization and access to this asset class with also opening it up to corporates as well. So we'll see how that proceeds along the way. They have not made an investment yet, but they are looking at all of our deals. Here's interesting. So David, and I'm not trying to throw you under a bus, given the high success rate and good projected yield on these types of investments, how do you look at, how should an investor look at OurCrowd sort of on the risk-return spectrum? Are these really risky investments? Are these sort of middle of the road? Is there a way you can sort of, even if it can't quantify, but maybe qualify it for investors?
Yeah, I mean, this is definitely a tricky question. These are risky investments. I mean, our goal as an investment team at OurCrowd is to be able to take early stage investment opportunities and to be able to de-risk them as much as possible. And we do that, through everything that we just talked about in the webinar. So we do that through a very rigorous diligence process. We do that, through ongoing monitoring support of the companies. All of those things are in efforts to maximize the probability of success. That being said, there are so many variables at play when you're talking about early stage companies that it's just very hard to predict the future. So many things could happen. So I would say that they should be viewed as high risk, illiquid investments. Therefore, when you're thinking about your overall portfolio allocation of your kind of all of your investments, so not talking about your early stage investments, but you're thinking about, here's how much investable capital you have and how to allocate that across, different asset classes, both liquid and illiquid. You should really only be allocating a small percentage of your portfolio to early stage investments. It's kind of the high risk, high reward piece. That's where it fits in terms of the matrix of risk reward profiles of what you should be looking for in your own diversification. So yeah, that's what I would say is that they're high risk, but for the potential for for significant upside if and when things do work out as we all hope they will.
So that's a really good point, David. I would also add to that even if you consider the entire spectrum of private investing as risky, there's a gradient within the risky types of investments. So we made some investments that we believe probably the best road to monetization is through IPO. That typically can take 9 years. There are other companies we think that will probably, could theoretically grow to be the same size of a company, but probably get taken out through a merger or acquisition much earlier. Some companies we feel that have a very stable sort of recurring business, so you can look at sort of almost like a DCF, right? Like a discounted cash flow forward. We have other companies that are just beginning to monetize their technology. So even within the realm of risky investments, there's sort of definitely different pigeonholes for our companies. That's a good segue into another question. We're nearing. Yeah, go ahead.
No, I was just saying that was a great point, and I just wanted to add one other thing about kind of when we think about these investments and about their exit potential. For us, we're really focused on do these companies have really great, deep, proprietary technology and a very clear business model? And if we believe that that's the case, And so long as there are some logical acquirers, in the industry, then we are confident that the exit will take care of itself. So we try not to obsess over, predicting exit scenarios, because we just know that if we're investing in great teams with great technology, that the rest should sort itself out.
Great point, David, and that's a great segue to our last question. We're hitting the end of the hour. Given what you just said, David, can you talk about our recorded successful exits or IPOs to date? No, we might have lost David. So the question came through: have we recorded any successful? Are you there, David?
I'm back. Sorry about that.
Okay.
So as you all know, or for those of you who don't know, OurCrowd's been around for a little bit over a year now, which, again, in line with everything that we've been discussing, is too short of a time horizon to expect any exits, at this stage. I think the best proxy for the continual progress of our companies and their success thus far is the fact that about 7 of our companies have raised subsequent rounds of funding already at valuation step-ups to our investment. So that's always a very good sign. It shows that they're continuing on the right path, and the market has validated our underlying thesis, and the company has continued to create value as it progresses. So there's a number of examples of those. A handful of which have been at increases in valuation in the 2x range already in just a matter of months.
So with that gets us to the end of the hour. There were a couple questions. I apologize if we weren't able to get to. If you email us at Zack at OurCrowd, Z-A-C-K at OurCrowd.com, or David.Stark, S-T-A-R-K at OurCrowd.com, we're happy to answer those questions for you. A couple of the questions that came through we'd actually addressed during the presentation. Again, if you're an entrepreneur and you're interested in undergoing, at least throwing your hat into the ring to see if you qualify to be, an OurCrowd investment, definitely send it over. We look at every deal that comes over. As David said, that could be as high, the volume could be as high as 300 potential deals per month. If you're an investor, I definitely, there's no cost associated with it. You just have to sign up on our website, sign up at OurCrowd.com. That'll enable you to see our entire deal flow. You'll see that deal launch process that we talked about in depth. And you'll be able to sort of see, how we work from almost the behind the scenes. You'll be able to get our emails, our events. You'll get to see sort of what we talked about tonight in practice. So I know everybody's very busy. Appreciate that you've taken an hour out of your day to spend time with us. Hopefully this was useful. Hopefully you'll be interested in attending future OurCrowd events. I'd like to thank you for joining us tonight. Send us emails. We're always interested to hear from our investors or potential investors and entrepreneurs. Thank you for joining us. And David Stark, thank you as well.
Thanks, Zach.
And with that, we'll conclude this Teach-In Tuesday. We have another event on the Portfolio Reserve product scheduled for not next Tuesday, but the Tuesday after. Hopefully you received an email about that. If not, email me and we'll send you an invite. Hopefully we'll see you on that call and future calls. Thanks, guys.